In 2022, AT&T cut its dividend by 46%. One decision. Millions of retirees who had spent decades building a portfolio around that payout suddenly found themselves short, not by a little, but by nearly half their expected income. They had done everything the plan said to do, and the plan still failed them. Here's the belief most people carry into dividend investing. Find stocks with a solid yield, accumulate enough shares, and eventually the income covers your life. It sounds logical. The problem is that the math required to actually pull that off is almost never stated clearly, and the number, when you see it, stops most people cold. So what does it actually take? Not the optimistic version, the real number at a realistic yield for a real income target. That gap between the dream and the actual capital required is what this video is about. And if you don't understand it, you'll likely spend years optimizing for income before you've built enough to make income matter, which quietly costs you more in long-run growth than the dividends ever paid back. My name is Alex, and if you've ever wondered whether your current strategy is actually moving you toward not working or just toward owning more stocks, stay with this, because the sequencing matters more than the yield, and I'm going to show you exactly how much capital you need at each stage of your life, and where the high-yield trap swallows people whole before they ever get there. Once you understand the passive income math, you'll stop asking which dividend stocks to buy, and start asking whether you're even in the right phase to care yet. That question, which phase, turns out to be the one most people skip entirely. Most people picture dividend investing as a simple equation. Buy enough shares, collect the checks, and stop working. The fantasy is clean. The math underneath it is not. Let's start with something concrete. Say your target is $50,000 a year in passive income. Not lavish, not a beach house in Malibu, just enough to cover a modest American life without clocking in. Figure out exactly how much capital you need to generate that. There's one formula. You take your target income and divide it by your portfolio's dividend yield. That's it. The output is your required principal, the pile of money that has to be sitting there, working before a single dollar flows to you. Simple formula. Brutal results. Here's where the yield question starts to matter enormously. Not all dividend stocks pay the same rate, and the spread between them is wider than most people expect. Take two companies that almost everyone recognizes. Apple currently pays a yield of around 0.39%. Pepsi sits at roughly 3.8%. Same stock market. Completely different math. Run the numbers on Apple first. To generate $50,000 a year at a 0.39% yield, you would need just over $12.5 million invested. That's not a typo. $12.5 million to replace a $50,000 salary from a single stock. Now shift to Pepsi. At 3.8%, your required capital drops to around $1.3 million. Still a serious number, but a completely different conversation. That gap, from $12 million to $1.3 million, is entirely explained by yield, which means the yield you choose isn't just a preference. It determines whether your goal is mathematically reachable in your lifetime. Now here's where it gets uncomfortable. 1.3 million sounds almost achievable compared to 12 million. But Pepsi is one of the most generous dividend payers among large American companies. A diversified portfolio doesn't look like Pepsi. It looks like a blend. Some higher payers, some lower, some that barely pay anything at all. When you average across a well-constructed dividend portfolio, a realistic yield lands somewhere between 2.5 and 3.5%. That's not pessimism. That's what the data shows when you look at actual portfolios held by actual investors. Run that math. To generate $50,000 a year at a 2.5% yield, you need $2 million invested. At 3.5%, you need around $1.4 million. So the honest range is somewhere between $1.4 and $2 million, depending on how well you build the thing. Think about what that means practically. A 38-year-old software developer earning $91,000 a year, decent salary, contributing steadily to her retirement account, maybe carrying a mortgage. Her current investable net worth is probably somewhere in the low to mid 200s of thousands. That's not unusual. That's roughly where the median American professional sits. At a 3% yield, that $200,000 generates $6,000 a year. Not $6,000 a month, $6,000 a year, about $500 a month. $500 a month does not replace a job. It pays a car payment. It is a starting point, not a destination. And that's the part the dividend dream tends to skip. The gap between where most people are and where the math requires them to be is not a small one. It's closer to $1.2 to $1.8 million of additional capital. That takes time. It takes compounding. And it takes making the right decisions at the right stages, which is exactly where most people get the sequence wrong. Here's the move a lot of investors make at this point. They look at that capital requirement and decide the answer is just to find a higher yield. Higher. Skip the 2.5% portfolios, load up on stocks paying 6 or 8%, and close the gap faster. It sounds like a shortcut. It is not. It is one of the most reliable ways to actually lose ground. And understanding why requires a close look at what a high yield is really signaling. That's the high yield trap, and it deserves its own explanation. There is a number that feels like a solution, but is actually a warning sign. That number is a very high dividend yield. And once you understand what it usually means, you will never look at an 8% yield the same way again. The logic that leads people here is understandable. You have just done the math. You need somewhere between $1.4 and $2 million to generate $50,000 a year at a realistic yield. That is a long road. So the brain starts looking for a faster path. What if you did not need a realistic yield? What if you just found stocks paying 6, 7, or 8%? Suddenly, the required capital drops. The goal feels closer. The shortcut looks clean. Here is what the shortcut is actually telling you. When a stock carries an unusually high yield, one of two things is almost always happening. Either the company is paying out more than it can sustainably afford, prioritizing the dividend over its own future, or the stock price has already fallen sharply, which mechanically inflates the yield percentage even as the underlying business deteriorates. In both cases, the high yield is not a reward. It is a signal, and that signal usually arrives just before a cut. The history of this is not subtle. Look at what happened to three companies that were once considered the gold standard of dividend reliability. 3M had increased its dividend for 66 consecutive years. 66. That is a streak that started before most of the people watching this video were born. It survived recessions, financial crises, and market crashes. And then, in 2024, it ended. The dividend was cut. Investors who had built their income strategy around that payout did not see a warning label. They saw a 66-year track record and assumed it meant something permanent. AT&T is the sharper example. In 2022, the company slashed its dividend by 46% in a single announcement. Not a gradual reduction. Nearly half gone overnight. AT&T had been a cornerstone holding in income portfolios for decades. The kind of stock a financial advisor would call boring in a complimentary way. And then 46% of the income it was supposed to provide simply disappeared. Walgreens followed a similar path. After more than 40 years of consecutive dividend increases, the cuts came. A pharmacy chain that had survived the rise of Amazon, the collapse of retail, and a global pandemic eventually could not sustain a payout that its core business no longer supported. What connects all three? None of them looked dangerous from the outside. They looked stable. They had long track records, recognizable brands, and yields that seemed attractive precisely because the stock price had already started reflecting the trouble underneath. That is the trap. By the time the yield looks irresistible, the deterioration is usually already underway. Consider a nurse in his mid-40s who spent several years building a concentrated income portfolio around high-yield stocks in the telecom and retail pharmacy space. His yield on paper was close to 7%. His portfolio generated real income every quarter. And then, across 18 months, two of his largest positions cut their dividends. His actual income dropped by 31%, not because he made a reckless bet, but because he mistook yield for durability. He has spent the years since rebuilding around a more diversified base, at a lower headline yield, with far more stability. The takeaway is not that dividends are unreliable. It is that yield without context is meaningless. A company paying out 6% of its stock price is not being generous. It is either struggling to grow, struggling to survive, or being mispriced by a market that already knows something you have not caught up to yet. Every dollar paid to you in dividends is a dollar not being reinvested into the business. At a healthy company with strong growth prospects, that trade-off makes sense. At a struggling one, it is a slow bleed dressed up as income. Avoiding the trap is necessary, but avoiding it alone does not solve the original problem, which is that even a well-constructed dividend portfolio may be quietly costing you more than it pays. That is the opportunity cost question, and it cuts deeper than most dividend investors are willing to look. Choosing dividends over growth is not just a style preference. It is a trade-off with a measurable cost. And most people making that trade-off have never seen the actual number. Start with a realistic baseline. The median net worth for an American household is currently sitting at around $217,000. That includes home equity, retirement accounts, savings, everything. It is not nothing, but it is also the number you're working with if you are a typical professional in your 30s or early 40s who has been doing things mostly right. Now take that entire amount and put it into a generous dividend portfolio, yielding 5%. 5% is already on the optimistic end of what a diversified income portfolio realistically delivers. The output is $10,850 a year, just under $11,000. That is not passive income that replaces a life. That is a modest car payment and a few utility bills. The point is not to be discouraging. The point is to show where most people actually start, and why the gap between that starting point and a workable dividend income strategy is not closed by finding better stocks. It is closed by accumulating significantly more capital first, and that is where the sequencing question becomes critical. Here's what rarely gets said directly. If you commit to a dividend-focused strategy too early, before your capital base is large enough to make income meaningful, you're not just being patient, you're actively limiting your own growth rate. Because dividend investing and growth investing do not optimize for the same thing, and when you choose one, you are implicitly giving up ground in the other. The diversification problem is more specific than it sounds. A portfolio built around dividend-paying stocks tends to concentrate heavily in a handful of sectors: consumer staples, healthcare, utilities, and financial services. These are stable businesses. They are not fast-growing ones. And by tilting toward them, you are simultaneously underweighting the sectors that have driven the majority of market returns over the past decade: technology, communication services, consumer discretionary. The companies are reinvesting aggressively into their own growth rather than paying it out to shareholders. The data makes this concrete. A backtest running from 2016 through 2025 compared a total market index approach against a pure dividend-focused portfolio. The total market strategy returned 10.49% annually. The dividend portfolio returned 9.43%, and that figure already includes reinvested payouts. The gap is just over 1 percentage point per year. 1% sounds small. It is not small. Take a 32-year-old teacher putting away $400 a month. Over 30 years, at 10.49%, that grows to around $920,000. At 9.43%, it grows to around $790,000. The dividend-first approach costs her roughly $130,000 over a working lifetime, not because she made bad choices, but because she optimized for income before she needed income. That 1 percentage point, compounded across decades, is years of additional contributions she would have had to make to close the gap. Now, you might push back here. You might say that the dividend portfolio provides income along the way, that the total market approach does not. And that is true. But here's the question worth sitting with. If you are 32 and still working, what are you actually doing with that quarterly dividend payment? In most cases, you are reinvesting it, which means you are not using the income. You are just collecting it in a slightly less efficient wrapper than a growth-oriented fund would have provided. The dividend is not wrong. The timing is. That is the insight most dividend content skips past. The strategy is not broken, the sequence is. And getting the sequence right means thinking differently depending on where you are in your financial life, which is exactly what an age-based strategy is designed to do. Because the right approach at 32 looks almost nothing like the right approach at 52, and collapsing those two into the same advice is where most people quietly lose ground. The question is never really whether to invest for dividends. The question is when. And the answer changes depending on one variable more than any other: how much time you have left before you actually need the income. Getting the sequence right starts with an honest look at where you are, not where you want to be, where you are right now, your age, your capital base, and how many years of compounding still sit in front of you. Because the right strategy at 32 and the right strategy at 54 are not variations of the same plan. They are functionally different approaches and treating them as interchangeable is one of the more expensive mistakes a long-term investor can make. If you're under 35, the dividend conversation can mostly wait. That is not because dividends are bad. It is because your most valuable asset right now is not your portfolio. It is your timeline. A 30-year-old with $12,000 invested in a 4% yield portfolio collects $480 a year in dividends. That does not move the needle on anything. What moves the needle is compounding total returns across decades, letting growth build the capital base that will eventually make income meaningful. Pulling toward yield too early trades the engine for the exhaust. The math on this is straightforward. A $400 monthly contribution growing at 10% annually for 30 years becomes around $820,000. Drag that return down by a full percentage point, as a dividend tilt tends to do, based on the back-tested data, and the same contributions over the same period produce around $700,000. The cost of early dividend focus is not theoretical. It shows up as a real number at the end of a working life. Now here is where the shift starts to make sense. Somewhere in the late 30s and through the 40s, the calculus begins to change. Your capital base is larger. Retirement is no longer abstract. It has a rough shape and a rough timeline. This is the window where introducing dividend-paying assets into your portfolio starts to serve a real purpose, not just an emotional one. The practical approach is to carve out a slice, starting small, around 5% of your total portfolio, and allocate it into diversified, dividend-focused funds. Currently, two of the most widely held options in this space are SCHD, which is the Schwab US Dividend Equity ETF, and VYM, which is Vanguard's High Dividend Yield ETF. Both hold diversified baskets of dividend-paying companies, which sidesteps the single stock concentration risk that burned investors in the 3M and AT&T situations discussed earlier. As you move through your 40s and into your 50s, that slice can grow, gradually in line with how close you are to actually drawing on the income, up to somewhere around 40-50% of the portfolio as retirement approaches. Think of it like adjusting a dial rather than flipping a switch. The growth orientation never fully disappears. It just makes room, incrementally, for reliability. There is one more variable worth addressing directly because it changes the calculation in a way that did not exist 5 years ago. The current interest rate environment means that a 3% dividend yield no longer exists in isolation. Right now, a high-yield savings account or a short-term treasury bill delivers a comparable return, with essentially no market risk attached. The stock market goes up, and the stock market goes down. And when you're holding dividend stocks, you ride that volatility whether you want to or not. If your primary goal is generating income today, rather than building long-term capital, the risk-free alternatives currently on the table deserve serious consideration before you assume equities are the only path. That context matters. But it does not change the fundamental sequencing logic. It just adds one more reason why chasing yield before your capital base is ready tends to cost more than it returns. Building the capital is the first job. Drawing from it is the second. Most people try to do both at once, and that is where the strategy quietly unravels. Which brings us to the part that determines how much of what you build you actually keep. Because once the dividends start flowing, the tax structure around them shapes the real return more than most investors account for. That is where dividend taxes enter the picture, and the rules are more nuanced and more exploitable than they first appear. Nobody talks about taxes until the bill arrives. And with dividends, the bill has a structure most investors have never fully mapped. One that can either quietly erode a significant portion of your income, or, if you understand the rules, leave you paying almost nothing at all. Start with the distinction that matters most. Not all dividends are taxed the same way. The IRS splits them into two categories: qualified dividends and ordinary dividends. Ordinary dividends are taxed at your regular income rate, the same bracket that applies to your salary. If you are earning well and your dividends get classified as ordinary, a meaningful chunk of that passive income goes straight to the federal government before you see it. Qualified dividends are taxed at the lower long-term capital gains rate instead. The difference between those two rates, depending on your income, can be 10 to 20 percentage points. That is not a rounding error. That is a structural advantage worth engineering your portfolio around. So what makes a dividend qualified? Two things. First, it has to come from a U.S. corporation or a qualifying foreign company. Second, you have to have held the stock for more than 60 days during the 121-day window surrounding the ex-dividend date. That 60-day rule is the one most people trip over. They buy a stock, collect a dividend quickly, and assume the lower rate applies. It does not. The holding period is not a technicality. It is the entry requirement. Here's where it gets genuinely interesting. If you structure your dividend income carefully, keeping your total taxable income below a certain threshold, your federal tax rate on qualified dividends drops to zero. Currently, for a single filer, that threshold sits at around $47,000 in taxable income. For a married couple filing jointly, it is around $94,000. Reach retirement with a paid-off mortgage, low fixed expenses, and a portfolio generating $50,000 a year in qualified dividends. And it is entirely possible to owe nothing in federal taxes on that income. Not a small amount. Nothing. That sounds almost too clean. And it is worth being honest about the limits. State taxes still apply in most cases. Social Security income, if you are drawing it, counts toward your total. Any ordinary income, rental income, part-time work, traditional IRA withdrawals, eats into the threshold. The 0% bracket is real, but it requires careful management of all your income sources, not just the dividend line. There are two other structural moves worth knowing. The first is the standard deduction. For a single filer this year, it sits at around $15,000. That amount comes off your gross income before your taxable income is calculated. For someone with limited other income, the standard deduction alone pushes the effective zero tax threshold meaningfully higher. A retiree collecting $47,000 in qualified dividends with no other income may owe nothing federally after the standard deduction is applied, even before any additional optimization. The second move is the Roth IRA. If dividend-paying stocks are held inside a Roth, the dividends grow tax-free and can be withdrawn tax-free. There is no qualified versus ordinary distinction to manage. There is no threshold to stay below. The tax question simply disappears. For anyone still in the accumulation phase, shifting dividend holdings into a Roth account where contribution limits allow is one of the cleaner long-term moves available. Now, here's the warning that catches people off guard. Consider a marketing director in her early 50s, automatically reinvesting every dividend back into additional shares through her brokerage account. The cash never touches her checking account. She assumes that because she did not spend it, she does not owe tax on it. She is wrong. The IRS treats reinvested dividends as income in the year they are paid, regardless of what you do with them afterward. The 1099-DIV arrives in January. The income is reported, and the tax is owed. Reinvestment is not deferral. It is just a faster way to buy more shares of a tax event. Understanding the tax layer does not change the fundamentals. It sharpens them. Because once you know how much of your dividend income you actually keep, the real return on this entire strategy comes into focus. And so does the final question worth sitting with before you decide how to move forward. Here is what this all comes down to. Dividend investing is not a flawed strategy. It is a sequencing problem. The income is real. The math works. But it only works once the capital base is large enough to make the yield meaningful. And getting there requires prioritizing growth first, income second, in that order, without exception. A few things are worth carrying forward. High yield is a signal, not a reward, and it usually arrives just before a cut. A 1 percentage point drag in annual return, compounded over 30 years, costs more than most people earn in several years of contributions. The tax structure around dividends is exploitable, but only if you plan for it before the income starts, not after. Watch for the moment you start optimizing for yield before your portfolio can support it. That is the inflection point where most long-term strategies quietly lose ground. One question worth sitting with: if dividends are the income layer, what is the right growth engine underneath them? And how do you build it without taking on risk that undoes everything above it? That is the compounding question, and it runs deeper than most people expect. If this reframed something for you, share it with someone still chasing yield. Subscribe if you want to keep pulling on the thread.